The US debt has just hit a substantial milestone of 100% of GDP. The last time we were even close to this amount of debt in the United States was around the Second World War.
This is kind of a flashing and shocking number. We had a 13% rally in the S&P 500, where pretty much the entire gain has actually been generated by 20 of the 500 names.
When you're overly concentrated, you are putting your 100-year family, your priorities at risk.
Not even a 100-year family, think 26-and-a-half-year family. If you look at the number of companies that were in the top 10 by market cap in the year 2000, there's only one of them that's actually there today. Blind diversification is actually what hurts a lot of people.
What's going on, everybody? Welcome back to AWM Insights. It's your host, Justin Dyer, Chief Investment Officer here at AWM, joined as always by Mena, Hanna, our portfolio manager here at AWM. And we're going to turn the conversation a little bit back to just some more current events. There's been some continued exciting news. 2026 has been a very, very interesting one. And talk about maybe not necessarily the most positive news on the one hand. The US debt has just hit a pretty substantial milestone of 100% of GDP. We'll go into exactly what that means, how we're thinking about that, how the 100-year family, the 100-year investor should digest all that. And then the current market rally. It wasn't too long ago, too many of these episodes ago, that we were talking about extreme volatility, largely due to the closure of the Strait of Hormuz, a conflict in the Middle East. And fast forward to today, here we are, markets at all-time highs. Certain parts of the market have just been on a tear. So going to cover all of those topics today and really, again, help people digest how should the 100-year family be thinking about current events, headlines. Some are a little bit more attention-grabbing. Others are fairly substantial, which we'll jump into around the debt piece of it, right? That is no small feat, if you want to call it that, where the last time we were even close to this amount of debt in the United States was around the Second World War, effectively. So here we are, just hit this, insignificant, but not for any specific reason other than that it's a nice round number of 100% of GDP. And Mena, before I turn it over to you, I'll just do a quick kind of definition. So GDP is effectively like simple rubric or way to think about that is the income of the United States or what the United States produces. Equivalent could be one's household income. And then the debt is pretty straightforward. I think we all know what that is, but we have now reached a number where it is 100% of GDP. So effectively, it's as though a household was borrowing 100% of what their take-home earnings were each and every year. Now, you might observe and say, well, actually, a lot of people have more debt than they're actually earning each and every year through a mortgage or something like that, and that's true. But governments and countries are different than households, and this level of debt is generally viewed to be a pretty unhealthy level. Where we go from here is anyone's guess. I mean, we'll comment a little bit about what may or may not happen, but yeah, I'll turn it over to you. Give us the level deeper. Where are we? What does it mean? And then most importantly, we'll turn to a conversation around how we think about it and investing for the 100-year family.
Yeah, the 100% level is a little bit arbitrary. I think it's one of those levels that just sticks out because it's a nice, clean, even number, but it is arbitrary. You brought up the example of household debt versus income. Most people, most normal people have way more debt than they do income. If they have a mortgage, if they, have a car that they're paying off, there are reasons, good reasons to take on debt and pay it off over time. Now, where this sort of deviates is our GDP is not going to move probably like the salary of a 25 to 30-year-old individual. So that's where vigilance comes in. Another point that people have sort of quoted is 120%. That's where a lot of economists kind of draw the line and say, all right, this is an unhealthy level versus something that we can sustain. Probably the more reasonable way of looking at it is we have this national debt on a yearly basis. What's the actual interest expense and how sustainable is that relative to our just budget in general? Think we're getting up there. This is kind of a flashing and shocking number because we haven't been at this relative level since the Second World War, which is a long, long time ago. But there are other governments. Japan's a great example. Japan's roughly at 250% right now.
And has been at high levels for quite a while.
For a long time, yeah. They have an aging population. They're in a different realm, but this isn't sort of a death sentence for an economy, at least I would say.
Yeah. Now, on the flip side, it's also not a rosy picture, right? And I think that's why you're starting to, we've been hearing, I shouldn't say starting, we've been hearing rumblings around the debt situation here in the US, whether it be economists, politicians during the election cycle. And then of course, politicians don't talk about it when they're actually in office. Yeah, right. They like to spend that money. So, it doesn't set us up as a country, and the knock-on effect there is potentially the markets over the long term for great returns, right? Now, is that going to be the dominant force in markets over the next, call it long-term period of time, 10, 20, 50 years? Or is it valuation, or is it something else, right? And that's the difficulty and really interesting part of the markets. There's so many variables that go into calculating returns or expected returns going forward that you can have opinion on each one in its own right, but acting on that opinion, we know, is just not a recipe for professional investing, right? And a professional investing to support that 100-year family, your priorities, what's most important to you in life. It could be that the debt, 5 years from now, the debt keeps creeping up and it does hit some unsustainable point. But again, to your point, there's no magic number. It's kind of going to be this slow burn, if you will. Or alternatively, right now, we do have higher valuations here in the United States. I say all that not to scare people and say, hey, U.S. is not a great place to invest. It obviously still is. I mean, as I alluded to in the intro, right? Like markets are doing fairly well. They did very well last year. A good year this year. I say all this with respect to U.S. specifically to give us comfort and to really underscore diversification, tried and true diversification. You talk about everything that's going on in the world right now, and one of the best, most comforting approaches to investing, in my opinion, is diversification, because the path from here is so uncertain. Picking who is going to win, the country that's going to win, you name it, diversification, it becomes a very, very, very compelling answer, in our opinion, my opinion, the most compelling answer. Alternatively, or in addition, let's talk a little bit about portfolio construction. So how do we think about that? How we think about the fixed income side? Because really, when we're talking about the U.S. debt, the biggest impact it will likely have, immediate impact, is on U.S. bonds, U.S. treasuries, the tried and true, backed by the full faith and credit of the U.S. government investment instrument that we use.
Yeah, and I'm so glad you brought up diversification, because in fixed income, diversification is great and everything, but blind diversification is actually what hurts a lot of people. And we've seen that in the past. If you think about and we were just talking about this, but the schedule of when a lot of these bonds are actually due, if we actually hit a debt crisis, it's not going to be short-term fixed income, which is the part of, call it the bond market that we like to invest in. It's not going to be the US's short-term obligations that we're not going to be able to meet. It's going to be those 10, 20, 30-year bonds. And we've talked about this a couple of times on this podcast. We don't invest in long-term treasuries. This is actually one of the reasons for that. The other reason I think is more tied to the 100-year family. 30-year capital is better invested into equity markets, in risk-on markets that could weather storms like this. So when you think about kind of where we're actually investing this capital, we're investing in a part of the market that is a little bit protected from potentially the storm that is to come. The US government is going to probably restructure 20-year, 30-year debt. They're not going to restructure the 1 to 2 year debt that primarily we're purchasing. So playing that game, I think, helps us be a lot more comfortable, and also just kind of taking 2 steps back and 1 step forward. If we do get into a situation where debt becomes unsustainable, typically what happens is inflation will increase substantially. Now, you're not going to feel those effects as significantly. Rates are also going to rise. You're not going to feel those effects as significantly if you're invested on the short part of the interest rate curve. And we're actually kind of already seeing that based on how people are pricing these bonds and how some of these auctions are going, where shorter term debt and shorter term vehicles are being priced in a much more favorable way because the market just has more certainty that the US is going to pay that off, versus the 20 to 30 year section of this curve is significantly elevated because there is a risk premium associated with it. So that's not necessarily capital or diversification that we involve ourselves in at all. 20 to 30 year debt that is going to make you 4.5% is not where we want to make money. We want to make, for those extended periods of time, money in public and private equity markets.
Yeah, that's right. That's super helpful. And there was some inside baseball, pun intended, kind of terms thrown in there, right? Curve, yield curve, things like that. All we're talking about is it's a plot or a chart of the point of maturity of various U.S. government bonds. Short term, meaning those are bonds that are coming to maturity or getting paid back in the short term, call it 12 months from today. Then you can go out 5 years, 10 years, 30 years, like you talked about. Those 30-year or 10+ year bonds move around quite a bit and are a little bit more sensitive to what we're talking about here today.
I'll throw a graphic up right here. And the average portfolio right now that I've seen is invested roughly at 7.5 to 10 years. So there is some, call it, timing risk by being that far out on the curve, I would say.
Yeah, right. Awesome. All right, let's move away from fixed income or the bond side of portfolio, which is super interesting, but probably only for us finance nerds, and talk a little bit about equity markets. So like I said again in the intro, it's been a wild month, wild 4 or 5 weeks. April was a phenomenal month, best month since 2020, I think was the statistic. That rally has continued here into the first week of May. We're on the back of earnings season. Just give us an overview of what's happening.
Yeah, and it's been such an interesting year. You sort of said this. We had the year start off strong. The war in Iran happened where equity markets tanked, and especially some of these big names really tanked, Microsoft being the most notable. And ever since then, we had a 13% rally in the S&P 500, where pretty much the entire gain has actually been generated by 20 of the 500 names. And the rally in general, we're currently close to all-time highs. It's been the narrowest rally that we've seen in recent memory. What that means is the number of companies that are at all-time highs is not as many as we usually have. So it shows that we've talked about the K-shaped economy before. We have a few winners in the portfolio, and this is why diversification matters, a few winners in the index, I should say, and a lot of companies that are kind of flat to down, but those winners are doing so well, and they're typically on the larger side that they're propelling the entire index up.
Yeah. And I like that you talked about or brought up this idea of K-shaped and kind of limited number of winners. And I would say a natural question potentially is like, oh, I wish I was in all the winners. Yeah, of course you do. Hindsight being 2020. But for the 100-year family, you actually shouldn't have that mindset, because when you're overly concentrated, yeah, you can get lucky and catch the right stocks, right names, right companies on the way up, and you look brilliant. But guess what happens on the way down? And there will be a way down at some point in time. It just is the natural progression and natural cycles of markets. Who knows when that actually happens? But the problem for the 100-year family, when you're exposing yourself to basically just increased volatility, and volatility is both ways, up and down, you are putting your 100-year family, your priorities at risk. You have less certainty in protecting what is most important to you, the flourishing family, right? That is what we talk about and preach time and time again. And we want to build portfolios that give us the highest level of confidence to support those and optimize returns to do that and outperform where we can. But we're never going to over-concentrate and chase, for that matter, a very small, isolated part of the market, because it's just not a sustainable way to support that 100-year family.
Totally. And this is a shameless statistic that I like to plug all the time. Not even a 100-year family, think 26.5-year family. If you look at the number of companies that were in the top 10 by market cap in the year 2000, there's only one of them that's actually there today, and that's Microsoft, who hasn't had the greatest time this year. Every other company, if you would have concentrated in all of these companies, I'm just going to list a few: General Electric, Nokia. If you concentrated in Nokia, I can promise you you're not doing all that well. Deutsche Telekom. These are not companies that have maintained their status as the best and biggest companies. So when you sort of take a step back and think about what the strategy should actually do, this is only a 26-year period of time. Toyota's on here. You have to diversify away from just those large names. Now, do you still want to hold them? Definitely, at the right weight, but you can't over-concentrate in them, because markets change, economies change, new companies emerge, and you want exposure to those new companies as they grow. You don't want to just be invested in the S&P 500. You want the Russell 3000, which is not 500 companies, it's 3,000. And you want exposure to the private markets as well. That's how you truly build exposure to as many businesses that have a chance of succeeding as you possibly can.
Right. And we do that to support the 100-year family. That's an awesome place to end. As a reminder, definitely shoot us your questions, topics, random thoughts.
626-862-0355.
We love having more and more, material for us to talk about. And we enjoy getting those questions. So keep them coming. But until then, own your wealth, make an impact, and always be a pro. Appreciate you all listening.